Hello, and welcome to this Economist event, Analysing Climate Change Transition Risk. My name's Guy Scriven. I'm the Climate Risk Correspondent at The Economist, and I'm delighted to be moderating proceedings today. So the idea of this panel is to discuss the big transition risks facing businesses. So that's everything from kind of changing regulation to shifting consumer preferences and new technologies. And in particular, we're interested in kind of how firms can measure these risks and mitigate against them. So here to dig into this topic with me, we have a fantastic lineup of panelists. We have Lisa McDonald, the Chief Risk Officer at ATB Financial, Kathleen McLaughlin, the Chief Sustainability Officer at Walmart, and Michelle Dunstan, the Chief Responsibility Officer at AllianceBernstein. Kathleen, I was going to kick off by talking to you and asking you about how Walmart, the transition risks that Walmart faces. It's a hugely kind of familiar brand and operation to everyone, and it's kind of an enormous business, and essentially kind of very important to a lot of people's everyday lives. So, how are you thinking about transition risks, and what are the big ones that Walmart faces?
Well, thanks, Guy. It's great to be here. And I just put that in context by, providing a bit of information about our plans around getting to zero emissions by 2040 in our own operations. And then we have a science-based target for Scope 3 as well. So we've made commitments to decarbonize our business. So for us, when we consider transition risk, it's more a question of how that will affect our approach to hitting those targets rather than might it change what we do around emissions reduction. In the first place, we've already made that commitment. Excuse me. So for us, there are multiple risks that affect the ability for us to meet those zero emissions targets in a timely way. So I'll just share a few. First of all, some regulatory and technology risks as it pertains to energy choices we might make to power our buildings as well as our transportation fleet. And so that's everything from changes to subsidies and incentives around demand side energy management, renewable energy generation. That's a big issue for us in many of the jurisdictions where we operate. Changes to carbon pricing regimes. We are advocating for a price on carbon. We think that's necessary. So in the meantime, we don't really have a settled carbon pricing landscape. We're excited about Article 6. Maybe we can get into that a bit in terms of what that can enable. But that's a significant issue for us. Changes to energy and water standards as they would affect our building management. On the transportation side, a whole host of questions and uncertainties around standards for fleet efficiency for medium and heavy duty trucks, the incentives that might come into play to facilitate a transformation around zero emission vehicles and the infrastructure required to support them. So will we see a regime, for example, that is technology neutral and allows innovation and experimentation? Or do we have a risk of certain approaches getting favored over others, which could lead to stranded assets or inhibit innovation and so on? And then, of course, on the customer side, a number of questions around policies that might incentivize different choices of different categories. So more energy efficient products. It can even pertain to things like food and, favoring meat alternatives that might be lower emitting alternatives for the customer. So there's a whole host of sort of regulatory and technology and policy in general uncertainties around those aspects. And then finally, I would even say some surprising ones. So for a business like ours, a lot of emissions lie in supply chains. So even considering what may happen in the agricultural sector, for example, to accelerate regenerative agricultural practices and so on that will help us even tackle emissions far upstream in food production.
That's really interesting. So thank you for that. And I was gonna bring in Lisa now. So ATB's financial is obviously kind of a very different type of business. So I mean, how do you think about kind of transition risk? Just how does it affect your kind of lending and investment decisions as a financial firm?
Thanks, Guy. First, I'll start off by saying that the views that I'm going to offer today are my own and not those of my firm. But I'll jump in with sharing that there's, similar to Kathleen's comments, there are a number of different ways that financial services organizations are looking at transition risk. And for ATB, that perspective really starts with understanding what's happening with our clients. And so we are a financial services provider in the province of Alberta, Canada. And the Alberta economy is driven by a number of very dynamic economic sectors, including, of course, oil and gas and also agriculture. And so we have a very unique opportunity to understand how our clients are responding and modeling transition risk. So as we look down into our client network, we see a number of different industries, similar to some of our panelists today, and obviously to everyone else who's attending this conference. So all firms are really looking at transition risk through a number of different lenses. Many are looking at it through the lens of looking at climate risk through the lens of ESG, because that's where investors and capital providers are expressing a lot of interest these days. There's a lot of regulatory change and policy intervention that Kathleen has mentioned, and also changing client demands. So we have quite a diverse set of clients, and we are connecting with them to understand how they are identifying and assessing risk, both at an industry level and at a firm level. The really fun part is in understanding how our clients are mitigating that risk, and looking at lots of different degrees of innovation and changes to their operations. So we are seeing an acceleration of collaboration across industries now, where firms are looking at pooling funds, pooling expertise to innovate and find bigger solutions at an industry level to reduce greenhouse gas emissions.
That's fascinating, Lisa. Can you give me a specific example? Could you?
Sure.
Maybe you can't get into client specifics, but can you tell me a bit more about the kind of innovation side of that?
Yeah, I'll give you one, and that's with carbon capture, utilization, and storage mechanisms in the oil and gas sector. There's a lot of work in that space to look at different types of innovation for how carbon can be captured through the oil and gas production cycle, stored for future purposes, shipped for consideration and use in other products and services. So there's a lot of work happening in carbon capture, utilization, and storage in Alberta. It's pretty exciting for many different industries, actually, but primarily for oil and gas. Lots of work as well in agriculture around bringing great new technologies into the ag sector. Ag tech is an emerging industry that Kathleen referenced a little bit. There's a lot more sophistication moving into agricultural production, and there's lots across all of our industries. We are observing firms look at more efficient business models, more energy efficient, water efficient, waste management efficient practices. So we wear two hats as a financial organization. We're looking at all of this wonderful activity happen in our client base. And then we're also impacted directly as well as a player in the financial services sector. We're looking at changes in, the competitive landscape, how other banks' risk appetite is changing, and how the industry perspective is evolving on lending to high emitting sectors, in favor of supporting a strong energy transition, but also, to do that responsibly. And we are watching for, changes in regulations in the financial sector space. Federal and provincial regulators are looking at the resiliency of the financial system and whether or not banks are adequately capitalized to withstand uncertainty as we move through this transition. So there are quite a few paths in which financial services firms are impacted as well.
That's really interesting. So, Michelle, to bring you in, I wanted to ask you about both Kathleen and Lisa mentioned kind of various types of different transition risks. I wanted to ask you about how you kind of can measure and analyze these kind of risks. I mean, the risk that, suddenly a kind of handful of countries impose some type of carbon pricing, obviously you can measure that if you know which countries they are and what price they'll put on carbon, but something like that presumably is actually quite hard to capture. So how do you go about measuring these kind of risks?
Thanks, Guy. Delighted to be here. And that's a really good question. And it is one that is actually increasingly important to our business today. So we're an asset manager. We invest in about, our assets under management are about $800 billion globally. So we are investing in issuers, stocks, bonds, other instruments. And we view this as something we need to do to be a good asset manager. We often get questions from our clients, asset owners who are just getting up to speed on climate change that don't truly understand the impact that climate change is having, not 5, 10, or 50 years in the future, but today. So this is a financially material issue for us right now. It's impacting cash flows, it's impacting valuation multiples, and it's impacting cost of capital. We can reduce risk and improve financial returns by integrating climate change into our financial analysis. So take an example, a manufacturing company that has factories that have carbon. Is carbon being taxed in the jurisdictions in which it operates today? If it is, you should be measuring that, including it in your cash flows. If it's not, what is the likelihood that it's going to become taxed at some point in the future? You can take a weighted average probability and include that in your financial analysis. If there's going to be cash out the door over the next few years, you'd want to understand that. What if there isn't going to be a carbon tax, but regulations are going to change, that this factory is going to have to install scrubbers? Again, that's going to be a CapEx hit, but as an asset manager, you'd want to understand. And then if you actually go further down the chain, some of those less tangible things. What about technology change? Has a competitor developed a new lower carbon alternative? Is your investment going to lose market share? Or is it going to have to spend money to actually develop that same product also? Or what about employees? They are increasingly making value-based decisions on where they want to work. We've seen some companies, take the oil and gas sector in particular, have tumbled down the ranks of where new university graduates want to work. What does that say about your company's capacity for technological innovation or keeping costs low if you are getting bottom of the barrel engineering talent? These are all real risks that are materializing right now, and one that we need to actually think about training and digging in on and educating all our investors on how to do.
And Michelle, just to follow up on that, I mean, so you listed a whole load of interesting and kind of quite different types of risk there. Are you able to give me a sense of what you think is the most kind of material? I mean, yeah. Go ahead.
It's a really good question, and the fact is that it's going to vary. What physical and transition risks impact a particular company is really unique to the products and services that it produces, the industry and sector that it's in, the location that it's in, the regulatory environment that it's in, and how it has positioned itself in the market, what it's selling. So what we actually need to do is educate people. So like at AB, we're a deep fundamental research house with 300 professionals around the world that analyze these instruments. Most of them have been here for over a decade. We didn't hire them because they understand climate change, but because they're good financial analysts or portfolio managers. So we've had to take that deep expertise in fundamental research and point it at climate change. And you really need to equip people to deal with this very complex and very multi-layered issue. And we've done that actually by partnering with the climate school at Columbia University here in New York. And we're the founding member of their corporate affiliates program. Our first step was actually education. So we co-developed a climate change curriculum that included the basic science, public policy, legal, regulatory frameworks, climate change solutions, that how to translate that into financial analysis. And we trained all our investors, over 300 of them. We actually offered to our clients last year, and over 1,000 of the world's largest asset owners enrolled. And we're now pivoting to research with Columbia. We have 5 different work streams with them. So we have to ensure that our analysts have the data and the tool sets and the support that's necessary. So this training gives them that basic one. How to identify, like you said, which issues are material, because it is a very diverse array of issues. We have ongoing training and education programs. And then there's a tiered system of support. The investors can handle a lot on their own with the tool sets that we have that provide them with a array of third-party and proprietary data and alternative data sets. If they can't do that, we have climate change experts at AB that can help them out. And if they can't get the answer through that, we then take our issues to Columbia and actually have interactions with the scientists. And I know you asked specific questions, but really you've heard from both Kathleen and Lisa, the issues that they're facing are very diverse. Everything from regenerative agriculture to carbon emissions to chlorofluorogases. It's a whole array of different things. And it's really difficult to say this is the one most important issue, which is why you need a lot of education, tool sets, data, and support to enable any organization to actually tackle this.
Sure, that makes complete sense. Thank you, Kathleen. I wanted to ask you about a kind of area that Michelle just brought up, which is data. So, I guess so I started doing this job maybe 2-3 years ago, and at that point, a lot of the conversation was about data. There are huge gaps in the data. We don't really know who's emitting what. We don't really know where the kind of risks are. So I wondered whether you could give me a quick kind of two minute kind of run through of where we are with data and how much progress you think has been made in the past few years in kind of improving the state of data around climate transition risks. And Michelle and Lisa, if you guys want to jump in on this one, because I know everyone's very interested in this topic, do put your hand up and I can come to you too.
Yeah, thanks, Guy. Well, you can tell by the comments we've made so far that we're talking about transformation of very complex dynamic systems. It's the entire economy that we're talking about transitioning over time. Perhaps unprecedented in human history to have the entire planet engaged together in transitioning the entire economy toward a goal of net zero. And so how do you model that? How do you model the risks associated with that? So what we found is there are some decisions and scenarios that we can create to inform those decisions where there's pretty decent data. And then there are others where who knows? And the best you can do is bound the problem. So I'll give you a couple examples. When it comes to actually understanding the physical risks, we have some decent scenarios from science to work with, right? So there's RP 8.5 when we used that. Hopefully worst case scenario around what could happen with the climate. And we were able to get a decent amount of insight into the impact of physical risks of climate on very concrete aspects of our business. So buildings, supply chain, surety of supply, transportation, future, and so on. When it comes to transition risk, every single thing we've talked about really depends on the actions of multiple people over time. And that's very difficult to model. So what we've done, for example, if you take energy, we can bound the problem and say, well, we know we're trying to get to zero emissions in our facilities. So for us, that means mostly transition of our energy source to renewable energy. It means a transition on refrigerants that is also significant and a transition on transportation. Those are the main drivers. So let me just take refrigerants as an example. We've got to convert our fleet of HVAC equipment across all our stores from existing models to future low global warming potential models. It's incredibly expensive today. So, we know one scenario is policy regimes that stay the same as they are today, and it's just a net cost for us, and we know what's available technologically today, and that may be a worst case. There are alternative scenarios where you see much more aggressive policy setting at state levels in favor of zero carbon refrigeration. That would be great. We would love to see that because it creates more of a certain and level playing field and sends a market signal to providers of the equipment for innovation. And so we can make assumptions then about what happens to the cost profile of that equipment across our fleet. So that's just one example. And every decision we face, every aspect of our business, we're trying to do the best we can with the information out there to model it. Something that's nearly impossible for us to assess is scope 3 emissions getting to net zero by 2050. What's the cost of that to Walmart? Who knows? That's saying the entire universe has to transition. How much does that cost? And we're only now seeing people try to come up with, examples that McKinsey, for example, my alma mater, full disclosure, but they're about to release quite an in-depth scenario modeling report that they've done that says, well, what's the cost to the entire economy across the different sectors we've been mentioning, the energy sector, agriculture, and so on, to transition from where we need to be to get to net zero. They've used data, a commonly accepted scenario for what that would mean. But boy, it is tough. And they're the first to admit, complex dynamic system, this is one path there. Who knows? There are many, many alternatives.
That's super interesting. And I'll have to find that McKinsey study. That sounds like great reading. Michelle, Lisa, what about from your point of views, just on data? I don't know if either of you want to jump in. Both of you, or I think Lisa mentioned, and Michelle, you kind of alluded to the question of ESG and how that plays in kind of capital markets, and there have been questions about the ability of kind of ESG raters to agree on who is kind of good and bad in lots of different aspects. And so I wondered if you had a sense of whether kind of the state of ESG ratings and ESG kind of data has kind of improved much over the past few years, or whether there are still big gaps. I don't know if either of you want to jump in.
Sure. Those are two separate things, ESG ratings and climate change data. So if you take ESG ratings, they are continually evolving and they are improving. But the fact is that there is no set path or no set way to evaluate this. So if you take bond ratings, credit ratings, for example, there's over a 99% correlation with the top two providers. With ESG ratings, there's less than a 50% correlation with the top two providers and only a 35% correlation if you throw in the top three. They're looking at different things and measuring it differently. We think of them as one source of information. They're a starting point. They're definitely not an ending point. Some of the common issues with ESG ratings are, one, they try and cram together E, S, and G into a single rating. So you can have a company that is wonderful on governance, has great social characteristics and credentials, horrible on E, and it gets a good rating. Or another issue, backward looking. They tend to average 5 years of historical data. And a company can change a lot in 5 years. And just like in financial analysis, we should take a forward-looking perspective. Improvement matters. We don't look at last year's EPS and say, I need to invest in this company because it had great earnings last year. You want to understand how that's going to evolve. And lastly, they're very focused on disclosure and web scraping. Does the company have a policy? Tick. Versus what you should be measuring, which is a company's strategy and actions.
Everything Michelle said, I agree with, and that's been our experience. And it'll be interesting to see what the SEC and other regulatory bodies come out with in terms of asking for standardized disclosures with respect to climate. I think that's a start. And, over time, I hope that regime will develop so that, Michelle, decision makers like you can actually get the data you need to compare companies apples to apples. The way we've tried to handle that is by disclosing ourselves as much as we can around emissions and our strategies. And to your point, what are we doing forward looking to not only decarbonize, but manage the various physical and transition risks and actually enhance our own disclosures in that regard? One of the other challenges that we see with ESG ratings indices, in addition to the ones you mentioned, because there's a lack of uniform disclosure from companies with actual comparable data, there is a tendency to over-rotate toward web scraping, social sentiment, and so on, which is easily manipulated by a whole host of actors for their own aims. So rep risk, or looking out at how many articles got written by one company versus another, and so on. And as a large company, we really suffer from that. And you can see that in climate, right? We believe that our actions result in forward-looking strategies are distinctive, but you'd never know it from the scores in aggregate from leading ESG providers.
Yeah. If I was going to say, if you take that to climate analysis, so there's a lot of providers out there that are doing climate change scenario analysis. And a couple of years ago, we kind of kicked the tires on the methodologies of about 14 different providers, and we enlisted the Columbia scientists to help us out with this. And a key learning has that this is really, really nascent. It's very much in its adolescent phase. There's no great solution out there. First of all, the underlying data is not complete. A lot, but not all companies report scope 1 and scope 2. Virtually no one reports scope 3. We'll get there eventually, but the quality of the underlying data set is not robust. and it's not particularly comparable. Different providers assess different risks. Some only do physical, some only do transition, some take into account both. And a lot miss the opportunity side of it. So for instance, a lithium miner might have high physical and high transition risks. On the other hand, there's a lot of opportunities from growth, because lithium ion batteries are what is in electric vehicles and increasingly grid level storage. And understanding the scenarios is really, really important. What is going into developing that? You can't just take a number and include it. You need to really, really understand what's going on. So we looked at portfolios and issuers across these different providers. And at a portfolio level and a company level, you got very, very different results. Let me give you a couple of different instances. For instance, one case, a copper miner was deemed low risk using one provider because the Toronto headquarters was being used. However, that miner has no mines in Canada. They're in Africa and coastal Latin America at high risk for impact on electricity supply due to water drought and sea level rise. Another one, two similar manufacturers. One reports scope 1 and scope 2 and scope 3. The other one didn't. Even though their underlying businesses are very similar, one provider was only picking up part of the data, and therefore they had very different profiles. So you really need to invest a lot of time in the interpretation and ensure, at least as an asset manager, that the analysts who are looking at their portfolio holdings and issuers are aware of the biases, flaws in the data they're seeking, and actually engage with the companies and understand it, as opposed to just taking that number is the one true picture of what climate change risk looks like.
That's
Maybe
really
I'll,
interesting and really telling examples. Lisa, sorry, I was going to say, do you want to jump in?
Yeah, I do. Thanks very much, guys. So I would agree with everything Kathleen and Michelle have said. There are definitely a wide range of reporting practices, certainly in relation to climate risk exposure and ESG. I just wanted to add that trend is changing. We are seeing a greater focus on disclosure and some better alignment around standards. Now, standards, are still very high level. There are big gaps in the standards that have been tabled so far. We're looking closely at SASB standards. There's lots of different frameworks that are emerging from Canadian securities regulators. Obviously, the IFRS group now is working on developing some better standards as well. So I think we're on a path. Those standards will help. But the data set is going to be problematic for quite some time to come. And, as we're looking at disclosures to help inform our assessment of our aggregate view of climate risk, we've also got to correlate that with financial performance, as Michelle has highlighted, and then credit performance as well. And so all of that is going to take time. The underpinning data sets are going to be ugly for a while. The modelers are not excited about this at all. And as that's from a bottom-up perspective, similar to Kathleen's comments, many organizations, including ourselves, are looking at top-down analysis, looking first at physical risk scenarios, but then we're looking at translating those scenarios into a range of economic assumptions. And as we proceed along that work, we have to look at what are the different policy alternatives that can be affected over time and in the near term. So all of that is very complex. None of the existing modeling tools or modeling capabilities we have in our organizations has worked through that type of analysis before. And Michelle commented earlier about some really strong partnerships with universities. We're doing the same thing. We're looking at some different regional analysis that's done that's being pulled together by universities in Western Canada to help us translate global scenarios into more regional impacts. Obviously, we've got to keep an eye on what's happening globally, but we've also got to understand how physical risks are going to impact performance in the near term. So we're doing that, but the modeling is going to be imprecise. It's going to be ugly. It's going to be wrong for a long time. And we need to layer in qualitative assessment as well. And so We are working qualitative scenarios on an ongoing basis. This is a space, that's very dynamic and is changing quickly in many aspects. So we are partnering with some different firms as well to help us think about qualitative analysis on an industry basis so that we can be a little bit more dynamic in our business practices as we're working that very long journey to evolve modeling capabilities and data sets.
That's really, really interesting. Thank you, Lisa. So it looks like we've got about 10 minutes left on the clock. So I was going to ask the panelists whether they had questions for any of the other panelists that they would like to ask. If not, I have a long list of questions I can continue to interrogate you with. But it may be more useful and insightful for our viewers that you ask each other questions. So does anyone have questions they'd like to pose to the other panelists?
Yeah, I was going to ask a question of you, Michelle. Something that I commented on earlier is, the perspective of changing risk appetite for capital providers. I know, organizations such as ours and financial services firms are looking not only at how do we manage climate risk, but how do we support a responsible transition, right? Because we all want to manage against material unintended consequences of accelerating activity in support of mitigating climate risk. So I wonder if you have a view of how investment firms are looking at changes in risk appetite as we, work through this transition. Is there a lot of balance that's finding its way into the mindset of capital providers, or are folks very hyper focused on, how do we get to that net zero goal?
That's a really great question. I think, we have seen an evolution. If you even go back 10 years, a lot of responsible investing or ESG investing was very values based. And it was really, I don't like this, I have widespread exclusions. I think we have really evolved from that mentality, which is a good thing, because there are multiple ways to approach this problem. And we do need to think about it differently, more deeply, and allocate capital in multiple ways. So I think what we're seeing now is people approaching it really in 4 distinct ways. One, which is becoming increasingly table stakes, is ESG integration. So let's evaluate the risks, evaluate the returns, incorporate that into our analysis, and make a decision that is now more fully informed, taking into account ESG and climate risks than we used to. That is becoming, basically everyone does that now, to varying degrees, and they're at different places along their journey. But we're asking the questions. Doesn't mean it's a no-go. It means we want to understand and quantify the risk. Then when you're looking at the capital allocation or investment side, I really think there are 3 kinds of things. One is more the best-in-class players, and that's a little bit more of a historical view. I don't want to own bad companies or companies that have high risk. Where we are seeing much more attention today on the risk side is in improvers. So being a part of that transition, supporting companies who are committed, supporting companies who are improving, actively engaging with them through your stewardship, through the company meetings, through the proxy voting, trying to get to those companies that have great strategies. Because what we want to see is that changing world. And I'd say the last is more and more money is being allocated to what I would call solutions or enablers. Companies that are producing products and services that are going to help others decarbonize. So yeah, I do think there is a shifting mentality here. It is including climate change and ESG and the risks, but there is a wider recognition that it's not just, I can only invest in best in class. I want to support that change, that drive forward too, which means a much wider range of companies are available for capital. And Kathleen, I actually had a question for you. You've spoken about a lot of the initiatives underway at Walmart, and there's a lot, and it's pretty broad and comprehensive. How do you get this done? How do you pivot or turn such a large organization to address some of these things, which, as you said, some of them may be perceived as, oh, this is just an incremental cost. How do you actually move from A to B and ensure that everyone in your organization, is aligned on that?
Yeah. Well, the first point is about leadership and cultural integration. So we've got a commitment throughout the company, just if I take climate, for example, to get to zero emissions by 2040 in our own operations, and through our Scope 3 initiatives, be part of the net zero transition by 2050. So that's deeply felt and deeply held at a cultural level from the leadership on down. And that's actually really important. So then the second is integration into our strategic planning, risk management practices, and operational planning. So you take that zero emissions target, for example, and cascade it down to each function. What does it mean for our store operations and our real estate choices? What does it mean for transportation innovation, of our fleet, our medium and heavy duty tractors? What does it mean then even for the merchants in terms of engaging suppliers and decarbonizing production of the products we sell? So, practically speaking, I have a team that then works with all of those teams to integrate the choices and decisions into CapEx, into OpEx decisions, into the quarterly action plans and the KPIs and the reporting. It's quite integrated at that level. And holistically, something like refrigeration is a net cost, but then where is an offset to that in our energy efficiency initiatives or renewable energy shifts that actually create positive, value or accretive to earnings, so that net we can make it work within the context of our broader economic goals. So that's how we do it. It's I think you said it first. Your first trend you're seeing is integration. I agree with you. That is tables. That's how we're going to get it done, and that's very much how we approach it.
Kathleen, can I just ask a quick follow-up question to that, which is basically about kind of scope 3 emissions, and it's something I've been wondering about, but have never really kind of thought about or managed to get a good answer on. But so essentially, over the last few years with the pandemic, you've seen, and this is happening to a kind of greater or lesser extent in different places, but you've seen a change in conversations about supply chains and how companies should be managing them, and there seems to be a kind of now greater emphasis on more kind of security versus efficiency. So less kind of just in time and bigger inventories and things like that. That seems to at least be the conversation. I don't know whether the data plays that out. But what I was wondering was, if that shift does happen and we move away from a kind of very fast, efficient supply chain model to one where there's kind of more security built into supply chains, where there's more where kind of risks are managed in a more risk-averse way, I guess. Does that have an effect on the kind of carbon emissions of a given supply chain or its environmental impact?
Yes, quite possibly. And, I think what you're going to see is less of a shift from efficiency toward, more days supply on hand and that sort of thing, and more optimizing the supply chain to get efficiency and resilience, a surety of supply. And that may or may not mean more inventory. There are other ways to solve for that. Mm-hmm. And so it's a much more sophisticated sourcing strategy that's optimizing across multiple variables. And so, in terms of emissions, mm-hmm. there are much bigger factors that are driving the emissions footprint of a category like beef or row crops, for example, palm oil, some of the heavier emitting categories. And I think the real impact on decarbonizing those supply chains comes more way upstream in decarbonizing the methods of production. And then in some other categories like laundry detergent, the heavy load on emissions is the way that customers use those products. So are they washing their underwear in cold water or hot water, for example? That's part of scope 3. Mm-hmm. And so it's something that we are, again, trying to translate the big goal of let's get to net zero into what are the practical choices we can bake into operational decisions with suppliers. That's really what our Project Gigaton is about. And, what we've done is work with the scientists to translate the choices around methods of production on the farm or the factory for energy, for agriculture, for packaging, for product design, and so on, into choices that translate to an emissions impact and get people focused on the biggest opportunities in terms of an emissions ROI. That's where you're going to see the real innovation around decarbonization. And I think this other challenge we have as a global society of managing efficient supply chains plus resilience or surety, that's less of a factor when it comes to the emissions.
Okay, cool. That's really interesting. That's good. That's good to know. Wonderful. Well, I think that's us for time. So that just leaves me to say thank you so much to all our panelists. This has been a really fantastic conversation, really interesting to me with lots of kind of detailed insights. So thank you so much for taking the time to join us today. And thank you to our audience for staying with us. And please stay with us for a bit longer yet and join us for our next session, which will be starting shortly. Thank you all, and goodbye.